So the UK's inflation rate dropped to 6.7% in the year to August, down from 6.8% in July. This is the third month in a row that these figures have dropped. So the prices of milk, cheese and vegetables from supermarkets actually fell last month. However, the prices of cereal did increase. So the slowing down of food inflation on items such as milk, cheese and eggs has helped drive this surprise fall. However, food price inflation overall is still very high at 13.6%. So most experts actually predicted the headline amount of 6.7% to actually have increased from last month, as there has been a recent rise in the cost of petrol and diesel, driven by a recent increase in oil prices. So the slowdown in the rise of increasing food prices, accommodation and air travel has led to the overall number being lower than expected. Inflation is the measured increase of the cost of something over time. So if a loaf of bread cost £1 at the beginning of the year and then £1.30 in the next year, the rate of annual bread inflation would therefore be 30%. So the Office for National Statistics, which is otherwise called the ONS, they track the prices of hundreds of everyday items in an imaginary basket of goods. So this imaginary basket is constantly updated. This is to reflect different shopping trends. So for example, if the price of a certain ingredient goes up, people will change their habits and buy a substitute instead of actually purchasing that ingredient at a higher price. For example, one of the recent changes that the ONS has done to the imaginary shopping basket is to remove alcohol pops and replace them with frozen berries. So each month's inflation figures that we see as a headline actually represent how much the prices of these goods in the basket have changed since the last month's statistics. So inflation can be measured in many different ways. However, when you hear of the headline amount, this refers to the CPI, which is the Consumer Prices Index. So as you can see from this graph, which shows the monthly CPI over the past several months, you can see that inflation seems to have peaked back in October 2022, when the headline amount was as high as 11.1%. So what exactly is core inflation? So core inflation excludes the price of energy, food, alcohol and tobacco. So core inflation numbers were measured at 6.2% in August, down from 6.9% in June and July, which at that time was the highest level since 1992. So the Bank of England takes all these numbers, they take the CPI and the core inflation numbers, and they put all this into consideration when they decide if they want to raise the interest rates. So the Bank of England has a target of an annual rate of inflation of around 2%. The current rate of around 7% is a whole lot higher than the Bank of England's target rate of 2%. When inflation is really high, the Bank of England traditionally likes to raise the interest rates to help reduce the amount of inflation within the economy. So when interest rates are higher, the cost of borrowing becomes a lot more expensive. This often means that people with mortgages or with any other sort of debt see their monthly repayments increase with interest rates. However, on the opposite end, when interest rates increase, the amount of interest the banks will be paying you to keep your money in them also increases. This encourages people to save more and spend less. When people have less money to spend, they buy fewer things. This reduces the demand of goods, slowing down the rate of increase of prices of such goods. When interest rates are high, businesses also borrow a lot less money. This also means that they are not put into a great position to be creating more jobs. And as a result, they can cut their staff, increasing unemployment. So in August, the Bank of England raised interest rates for the 14th time in a row, making the central bank interest rate at 5.25%. By the time this video is out, the Bank of England's decision for either raising or keeping the interest rates the same will be announced. And given the data we have at the moment, it looks like the stock market has responded very positively, with the FTSE 100 and the FTSE 200 rallying in response to these lower than expected inflation numbers. So soaring food and energy bills throughout the past few months have led to this increase of inflation. Oil and gas have been at a much higher demand since COVID, and the conflict in Ukraine has driven up prices of oil and gas as a result of troubled supplies. This conflict has also made the export of grain from Ukraine, which is a massive provider of grain, at jeopardy, and as a result, prices of food worldwide have increased rapidly. So during February of 2023, the problem of food price inflation was made even worse when there was a huge shortage of vegetables. This took food price inflation to a 45-year high. So what about wages? We see that inflation increases the prices of goods, but how are wages keeping up with inflation? So looking at official figures, we can see on average regular pay, which excludes bonuses, rose by 7.8% between May and July compared to the previous months, May and July. So this increase in wage growth nearly matched the rate of inflation within the same time period, which in actuality means that wage growth was almost flat for the first time in 2 years, after having fallen behind considerably before that. However, in reality, unions say that workers have received much smaller pay increases than what has been advertised, and there are still a lot of strikes due to pay. However, the government is worried about a wage inflation spiral, where to combat inflation, you increase wages. However, when you do increase wages, the cost of everything goes up, meaning that eventually the cycle never breaks. And no matter how much you increase wages by, inflation would always be there to eat away actual wage growth. So when will inflation finally be going back down? Lower inflations doesn't mean that the price is falling at all. It just means that the rate that prices are increasing is reduced. The Bank of England predicts that by the end of 2023, the rate of inflation will drop to 5%. Previously, the Bank of England has anticipated that by the end of 2023, the rate of inflation would be at 4%. The Office for Budget Responsibility, or the OBR, which assesses the government's economic plans, previously predicted that inflation would drop down to 2.9% by the end of the year. In January, Prime Minister Rishi Sunak said that halving inflation by the end of 2023 was one of the government's 5 key pledges. So in the US, an economy that is closely linked to the UK, the rate of inflation was 3.7% in the year to August, up from 3.2% in July and 3% in June. So as a result, it is expected that the US central bank is going to raise interest rates again. This would be the 11th increase since early 2022 and also the highest rate in 22 years. So it's still too early to predict with any certainty when inflation is going to come back down to levels that we have been accustomed to before. However, one thing is for certain, and that is nothing is for certain in terms of interest rate. And as a result, investors are not sure if the stock market is going to go up or down, and volatility seems like the only certainty in the market. So make sure to check out some of my other videos, and I will see you in the next video.